Okay, good day, everyone, and welcome to another training session with me. My name is Nana Obina Alexander. I'm the head market analyst and senior educator at ANZO Capita, Nigeria. Okay, so let's jump straight into it. Today, we're going to be looking at Elliott Wave, right? It's one of those trading systems. It's not a strategy. It's just something you need to understand about the market in terms of market structure, in terms of how the market moves. For those of us who are traders, I know several times you look at the markets, maybe you've learned structure, you've understood, somebody has taught you market structure at some point, and you have an idea as to how to understand what the market is saying, right? So you wonder, okay, the market is bullish, you're trying to buy, and all of a sudden it appears like it's breaking bearish and then it's breaking back bullish. So it's always as if the market is confusing you. Now there's a man, his name is Elliot. He came up with a theorem, right? And we'll look at that Elliott, the theory he came up with. We'll try and interpret it and see some of the basic principles, and then we'll go over to the chart and look for some chart examples, okay? Now, what is Elliott Wave theory? Okay, so Elliott Wave is named after a man. His name is Ralph Nelson Elliott, and he died in 1948, January 15, 1948. He's an American accountant, and what he did is, he came up by looking at the markets. He studied Dow theory. Now, Dow theory is also another theorem in the market, just like the Wyckoff theorem. So personally, there are three basic theorems that affect my trading, right? So there's the Wyckoff, which basically shows the manipulation that occurs in the market in terms of the composite man. The composite man, having to buy and sell orders in order to manipulate the weak hand. So weak to strong hand transfer. And then there's the Dow theorems of market movement. There's also the Elliott Wave theorem. Now, Elliott Wave is developed by Mr. Ralph Elliott, and he did this by studying Dow's theorem and observing certain nature in the market. So he concluded that the movement of the stock market, now he did this by observing the stock markets, but you can apply this to, to the Forex market in terms of currency trading, commodities and all. You'd still see the market move in this type of identifiable repetitive patterns of waves, okay? Now, the Elliott wave is interpreted as follows. Now, I'm just going through the basics so you understand where we're coming from. So when we're looking at the chart, you understand exactly what you're looking for. Now, basically, what he discovered is, or what he figured out and built into a theorem is the fact that the market always moves in wave. Now, we have identified that when we looked at the market structure, we understood that market doesn't just move up in a straight line or move down in a straight line. It moves in a series of waves. If price is going up, it tends to make higher highs and higher lows. And if price is coming down, it tends to make lower lows and lower highs. So what you understand is, let's say the market is in an uptrend. It's not always the case. It's not going to be, even though he defined it as a 5-way motion, it could be 6, it could be 7, it could be 4, but you'd see the pattern, right? So basically, there's a 5-way motion in which it shows the main trend. So the market is, let's say the market is bullish, right? So the market is bullish and price is pushing higher, right? The price is making higher highs, higher lows, higher highs, higher lows. We established that kind of market is what we call a bullish market. Now, what he deduced is that in a bullish trend, right, if the market is really interested in going up in a bullish trend, what you discover is that it makes, it will go up in 5 waves. So 5-wave motion. So wave 1, wave 2, wave 3, wave 4, that's this other one, and wave 5. So you understand that there's an approximate 5-way motion in the direction of the overall trend, and then there's a corrective 3-way movement, as if the market has changed trend, before we now see the continuation of the 5-way motion. Now, don't worry, when we look at the charts, or when we look at some examples, you'd see how this makes even more sense, right? So basically, we know that in a bullish market, price tends to make higher highs and higher lows. What he's saying is, even though the market is bullish and price is really making higher highs and higher lows, there are certain times where it will appear as though the market is now making lower lows and lower highs. But don't let that movement confuse you, because the market is still bullish. And that's why you see something like this, and then the market will continue making its higher highs and higher lows, and then do something like this, and then continue making its higher highs and higher lows. So it's a structure, a situation where the price is moving in two directional waves. So there's the impulse wave, there's the correctional wave, and then there's an impulse wave. So they follow through themselves in that format. Now, this is actually quite important when you put into consideration the fact that we like to trade from a position of understanding market structure, because once we understand market structure, we are able to understand where the price is headed, because the goal of trade or as traders is for us to be able to understand where price is going. Once we're able to understand where price is going, it gives us an advantage, an edge in the market to know whether to be looking for buy or sell opportunities. I hope that makes sense. Okay. Now, so here's an example. So price will make a wave 1, right? Wave 2, wave 3, which is usually wave 3 is usually the longest wave. So wave 3, wave 4, and wave 5. Now, after making this 5th wave, price usually tends to make a corrective with 1A, B, C. Now, usually, this ABC wave, which, if you're looking at this, it will appear as though the structure has shifted, as though price is now bearish, right? As though the market is now ready to start going lower. But what he discovered is it is okay for the market to do this, right? Where in this case, you can see the correctional wave, the wave C is actually lower than this low down here. And here is where people get it wrong. And when they see this, they instantly begin to look for sell opportunity, only for the markets to continue breaking high. And they wonder why when they look at this, when the market doesn't respect their structure. So understanding this theorem, the idea behind the Elliott Wave theorem is actually quite key. And this has actually helped. This is one thing I always tend to look out for. So as to whether a trend is still on, right? Or whether we are just doing a corrective Wyckoff wave. So many times you see the market make move, and then the moment it breaks down, everybody begins to look for sell. Now, Wyckoff is saying this doesn't necessarily mean that the price is now bearish. This is just could just be a corrective wave for price to now continue breaking higher. Okay, I hope that makes sense. Now, don't worry, I'll show you this on the chart with some examples, and we're going to try and make sense of it. Now, what's the basic principle? Now, simply put, the movement in the direction of a trend is unfolding in 5 wave. Now, just because I put 5 wave here doesn't mean it can't be 4 or it can't be 6. You just need to understand that what is the overall trend. Once you understand the overall trend, right, then you want to understand that it is okay if price appears to move against the trend, or it appears to break the trend if it makes a corrective with A, B, C. Now, if that's the case, that doesn't necessarily mean that price is now bearish, right? That doesn't necessarily mean that price is now bearish. Now, while any correction against the trend is in 3-way, so after the 5 wave in the direction of the trend, there's a corrective 3-wave correction. Now, the movement in the direction of the trend is labeled as 1, 2, 3, 4, 5, and the corrective wave is labeled as A, B, C. Now, this pattern, you can see it on the chart, on every single time frame, on every single instrument, on every single asset class. And here's the thing about the Forex markets. The market is fractal. Now, what that means is, if I show you a 1-minute chart of gold, for instance, you won't be able to tell me whether it's a 1-minute chart or a 1-month chart if I cover the time frame, because the market will still, whether it's a 1-minute chart or a 1-hour chart or a 1-day chart, you still see the market make higher highs and higher lows, make candlestick formations, and still move in a similar type fashion, right? So even the concept of fractalization is the fact that, okay, so let's say there's a wave 1, let me draw here, there's a wave 1, 2, 3, 4, 5, right? Now, in this wave 1, 2, 3, 4, 5, right? Let's say this is a daily chart. Now, if that's a daily chart, if you drop down to the 1-hour chart, or let's say a 30-minute chart or whatever, you could see the market do something like this. Now, why this is one wave, you'll see something like this: 1, 2, 3, 4, 5, 1, 2, 3, 1, 2, 3, 4. So this move here that we're categorizing as one wave movement, right? So this movements. So somebody's saying that they don't understand. Well, you need to understand. You need to understand market structure. Don't worry, if you do understand market structure, maybe when we start talking of some examples, it will be able to make more sense to you. Now, the basic idea, this is the basic idea behind the Elliott Wave principle. The fact that, well, while the market is moving in, while the market moves in waves and structure, it's okay, right? It is okay for price to break within certain areas, appearing to have negated the trend. Now, please, you can ask questions right now. You can unmute yourself at this point because this class is being recorded. So just keep your questions. After, when we're past this session, you'll be able to ask your questions. Okay, please. Okay, now, so what I was trying to say is, based on the Elliott Wave principle, there is, once the market is moving in the direction of the dominant trend, it will move in wave. We already know that based on our understanding of market structure, price moves in waves. Now, once we know that, we also need to understand that, well, just because price is moving higher highs and higher lows, Elliott Wave is saying, even if price breaks as if appears to make a lower low and a lower high, that doesn't necessarily mean that the trend has changed, right? It's saying that that break that appeared to now start making lower lows and lower highs could be a corrective wave for price to then continue in the overall direction. Don't worry, this might sound like a handful, but I'm guessing once we go over to the chart, it will begin to make more sense. Now, the concept of Elliott Wave takes into consideration the fractal nature of the market. I've said this because where the smaller piece is broken off, the bigger piece also, so it's like pieces of the jigsaw, right? So you have the market moving in 1, 2, 3, 4, 5 Elliott Wave. Now, if this is a daily chart, right? If this is a daily chart, you would also be able to find that even this wave 1, remember this movement here is the wave 1, on a 1-hour chart might look like this, right? So it has its own structure, right? And this move downward would also have its own structure, right? So that's what I mean by the fractal nature of the market. So the Forex market is a combination of there's a 1 minute time frame, there's a 1-hour time frame. And in each of these time frames, you'll be able to identify different trends. And within those trends, you still see that the lower time frame would act like the higher time frame, and the lower time frame is controlled by the higher time frame. So that's what I mean by the fractal nature of the market. And it's all nice and good when you begin to understand, when you understand market structure, you can begin to apply Fibonacci relationship to the wave pattern in the market. And then more importantly, you'll not be confused as to why does it seem that the market is breaking or has broken trend, let's say from an uptrend to a downtrend, but then you're trying to sell it and then it goes back into the uptrend. You need to understand that the concept of Elliott Wave theorem is actually why that happens and why the market tends to move in that way. Okay, so it doesn't matter the time frame you're looking at. It doesn't matter what time frame. Like I mentioned, the market is fractal. Price is fractal, meaning a 1 minute chart. If I don't tell you it's a 1 minute chart and I show you a 1 minute chart and a 1 month chart, you won't be able to tell me the difference if I close the time frame, right? And that's what I mean by fractal nature of the market. This is the reason why you can apply price action trading system on a 1 minute chart. You can apply other blocks and Y curve accumulation and distribution in a 1 minute chart as the same way you can apply it on a daily chart or a monthly chart. Okay, so that's that. So here's a good example of what I mean by the fractal nature of the market. Now look at this, right? If you're looking at this, you should be able to see, let me just highlight it. So this is a wave 1, right? Wave 2, wave 3, wave 4, wave 5, right? But look at wave 1, that's this first one. You can see that it also comprises of its own, where's my pen? It has its own wave 1, 2, 3, 4, 5, right? And then the corrective 1, 2, 3. And then we have our other 1, 2, 3, 4, 5, and our corrective with A, B, C, and the same thing over and over again. Now, even though this, so I think the chart is now looking very scribbled, but you should, let me clean up some of it. So this is a wave one, but just the wave one is its own, within a smaller time frame, would look something like this, right? 1, 2, 3, 4, 5, and then a corrective A, B, C. And then you have a wave 2 or wave 3, which will be its own 1, 2, 3, 4, 5. And then you have the corrective wave 4, which will be the A, B, C of that. And then you have the continuation again. Now, within whatever time frame you're looking at this, you should be able to, you'll be able to see price movements, right? So here's a good example of what I mean. Now, for those of you who understand market structure, break of structure, and all of those things, this is a situation where naturally you'd be looking at this area, right? So you'll be looking at, okay, it seems market has broken below this low, and so the market wants to go down, only for markets to break high and continue to go up. And you wonder why this break of structure is not held. So Elliot is taking into his Elliott Wave theorem is telling you that it is okay for price to appear to break below, right? Or appear to change structure. It's okay, because that doesn't necessarily mean that the overall trend has changed. Now, don't worry, in a later class, I'm sure in the next week's class, I'll probably talk about Dow's theorem. Dow's theorem is, the concept of Dow's theorem is how I personally figure out, okay, what is the structure? Right? What is the structure? What do I consider a clear break? What do I consider a break of the actual structure? So please, whoever is scribbling, annotating on my screen, would you please stop that? Okay, so now we'll go over and look at some chart examples, and I'm sure this will begin to make more sense. But you get the idea. We have a wave 1, or wave 2, wave 3, wave 4, wave 5. And then we have a corrective wave 1, 2, 3, which could then continue another wave 1, wave 2, wave 3, and you get the idea. Now, just because we're using 1, 2, 3, 4, 5, it's not a, it's not a hard and fast rule, right? Sometimes you'd see something like maybe it's just a 4 wave, sometimes it's a 6 wave, but you get the idea. The one that's non-negotiable is actually the corrective wave A, B, C, right? But the wave itself, yes, Elliott Wave theorem says it has to be 5 wave, but what I figured is it could be 4 waves, it could be 6 waves, it could be 8 waves. It doesn't really matter. What's important is we could see a corrective breakdown that is not necessarily a change of structure. Okay, I hope that makes sense. If what I've been saying now makes a little bit of sense, just quickly type in some yes, so I know at least I have some people who are understanding what we're saying. Okay. Now, again, you'd see this in every, for those of us who let's say look to trade channels and trends and stuff, you still see this same concept within stuff like flag patterns, bearish channels or bullish channels or wedge patterns, or even head and shoulder patterns. You'll be able to see this. You'll be able to apply the same concept of Elliott Wave. The main goal of this is not an entry criteria. This is not, sometimes I teach you price action trading system, Wyckoff accumulation and distribution schematics to help you get into, okay, how do I enter a trade or exit a trade? This is not about entry, it's about understanding. You remember, even if you have the best setup, but you're looking at it wrongly, you still make losses, right? So this is to get to sometimes it appears as though anytime you buy, it seems the market starts to sell, and anytime you sell, it seems the market starts to buy. It's as if you're unable to figure out what the actual direction in the market is. This is one way to enable you avoid bad trades, basically by understanding what the actual structure in the market actually is. Okay, I hope that makes sense. So now I think we can go over to our charts and look at some chart examples. We'll see if we can find some good examples to illustrate. I think it will begin to make more sense on the charts to illustrate that. But then I'll leave you with this word: until what you know becomes what you do, well, you'd always be broke. I'm sure you can all agree with this. It's one thing to know something. I'm sure we all know that you should not trade without stop loss. We all know that you should use proper risk management. But when it comes to the tick of the action, we forget what we know and do follow our heart. When it comes to trading, if you want to be successful, you actually don't need to follow your heart. Don't trust your heart. Trust me, don't trust your heart. Okay, so let's go over and look at some chart examples. Okay, I'm getting your feedback. True. Let's go over and look at some chart examples and see if we can spot some trading ideas on this. Now, quickly, I don't have this planned out. I don't have a a perfect example. And then remember, it's one thing to it might not exactly be perfect like we saw on the Elliott Wave itself. But basically, you should be able to understand the concept, right? So Elliott Wave is, if the market is bullish with 1, 2, 3, 4, 5, there could be a corrective with A, B, C that could break the structure, but that doesn't necessarily mean that price is bearish. Okay. Now, just simply looking at this, let's basically figure out what the trend is. Now, I can pick any fractions of time, any fraction of time, and use that as a case study. I think I can see something here. Let me see. Let me just highlight this area and make it. Let's just call it structure. Okay. Now, so this is a daily chart of this Euro USD. So this the daily chart of Euro USD. So now this is the daily chart. If I drop down into the 4-hour chart, let's see what this place looks like. Here. Okay, so now if you're using TradingView, there is I think there is a tool that says Elliott Wave. So if you see Elliott Impulsive with 1, 2, 3, 4, 5. So it's just to draw. Now notice this. So this is an example. We have with 1, right? Now it might not be perfect like we see on the example, with 2, with 3, with 4, and with 5. Now this could even be 5. Now Elliott Wave doesn't go more than 5, but you could even be 5, 6, right? So with 5, 6, 7, right? However, what happened? I'm just going to take this as with 5 because I can't draw a 6 and 7 because the 2 only allow me to draw 5, right? Now, what you see is, notice that price made the corrective with A. It's not about how many waves it is, but notice something. We have A, B, C. Now, this break here, for somebody who's looking at structure, we'll look at this and say, oh, price has broken above this area. So the market is no longer bearish, right? We have with 1, 2, 3, 4, 5, and then we have the corrective with A, B, C. Now, somebody without the understanding of Y curve, or somebody who is looking at this with the wrong mindset. Now, if I take this now, I can still consider this an inverse. Somebody will look at this and say, this is an inverse head and shoulder, right? Oh, look at the left shoulder, look at the head, look at the right shoulder. Price wants to break up. But Elliott Wave, Ralph Elliott is saying, just because we have this something that appears to be break of structure, it doesn't change the fact that the actual trend is bearish. And what happens is, well, notice price continued in the overall structure, began to make another wave 1, wave 2, wave 3, wave 4, wave 5. Now, in this case, it didn't stop at wave 5. It just kept making structures lower. Now, this is the 4-hour time frame. Even within this time frame, something like here, right? I can just take this area here, for example, and you'd see that I could still, this could be at 1, 2, 3, 4, 5. And what happened? Price began to move up as though it is correcting, as though it's now bullish, only to make it with A, B, C, to then continue breaking down lower. So the whole idea is, now here's where traders like myself would have the edge, is that while we're looking at this and everybody's seeing this bearish market like this, right? So they're seeing these bearish markets begin to break higher and form. And so what they will be seeing here, what most people will be seeing here is, let me use this instead. They'll be seeing this break of structure, right? That, oh, price is now breaking higher. So price wants to go up. However, with the understanding of Elliott Wave theorem and also the understanding of Dow's theorem, I would be looking for an opportunity to sell. I think there was a good trade setup that I had in, I think it was last year on UJ. I think I just remembered. So USD JPY, let's see if I can point that out here. Let's look at the daily chart. Yes. Now, this was a very good example. I remember this was late last year. Was it? No, there's that. Yeah, it was here. This was around toward the end of last year. I remember everybody was looking at UJ and expecting UJ to drop, right? Well, not me and not some of my students, because we were still looking for the continuation. Now, if you look at UJ, it was stretched. As a matter of fact, some of you would know that I was a buyer in this market for over a year. Like I had a trade running for over a year. I was buying from almost the absolute low, somewhere. Where's my pencil? I was buying from around here. No, that was, I think it was here. Or I think October 2021. Accumulated more positions in 2022, and I was riding the trend. Obviously, I'm not going to go and start breaking down that trade. It was based on a different scenario. But the whole idea is, while this market began to push higher and continue to make higher highs and higher lows, the problem is when the market is bullish, most people are trying to sell it. And this is why people get wiped out. The market is bullish and people are trying to force sales. And what will happen is when the market becomes bearish, people try to buy it. And they'll be wondering why they keep getting liquidated. Now here there was a very good example of Elliott Wave within this structure, which I actually remember mentioning. So we have, let me pull this up. So we have, it was somewhere around here. So if you draw this, we have wave 1, wave 2, wave 3, wave 4, and wave 5. Now, the wave itself, you could pick any of them. But the main point is people actually started looking to sell this market within this area here. So let me just highlight the area. So within this area, a lot of people, if you start to look at, check the COT reports, you look at trader sentiment, a lot of traders were interested in selling these markets because they feel the market is overstretched. Look at it, oh, it has gone up too much, it has to come down. Again, the same thing happened within this area here. A lot of people were looking at this, oh, the market has gone up too much. It has even broken structure, right? Look at this. Oh, the market has gone up too much. It has even broken structure. Price is ready to start coming down. Well, I was looking for opportunity to buy. I was actually accumulating buys, and I ended up closing most of my trades, I think, from around the highs, not exactly at the extreme highs, but around the highs based on that same principle. Now, if you look at this area here, this is a daily chart, you might not see it very clear, but let's see on the 4-hour chart, this area here would look something similar to structural shift. So you start seeing wave 1 or A, B, C, which will be the end of the corrective wave, which would make most people begin to look at this as an inside break of structure, right? To begin to maybe look for Fibonacci retracement to sell, or maybe look for previous order blocks to sell from, not knowing that if with an understanding of Elliott Wave theory, it doesn't necessarily mean, just because market is breaking structure, doesn't necessarily mean that the trend has failed. Now, in this case, obviously the trend has failed, but this is where a good understanding of Dow's theory. I'm not going to go into Dow's theory in today's class. We'll leave that for another class, hopefully maybe next week. But what I used to wait for an actual break or an actual change of structure or trend is actually Dow's theorems. Because then it tells me, okay, what to look for. The quick break would be, well, if the market is bullish, right, it will stay bullish, or Dow's theorem consider this market is still bullish, even if we have a break of structure like this, right? Even if we have a break of structure like this, it will only consider the market bearish if we have another break, right? So for instance, if the market just stops here, so if the market breaks below this one and breaks below it again, that doesn't consider it a change of trend until we actually break below it again, at which point, you can now start to look at this and say, okay, it seems we have changed from a bullish to a bearish trend. So this understanding is very useful, very, very useful, or can become very useful to enable you not be trading against the trend or trade, be confused. A lot of the time when people feel that they've gotten the trend right, they usually go load on and begin to feel that they're going to make a lot of money and then wonder why the trend or the structure doesn't hold, not knowing that they are looking at it with the wrong perspective. Because remember that saying, the trend is your friend until it's broken. The truth is, the market likes to stay in the trend. And the reason is because most people expect the trends to fail. Now, the truth, the reason most people lose money in the market is because, well, the Forex trading is a zero-sum game. The losers pay the winner, right? So, well, in most things, more people lose. And more people are doing the wrong thing. The crowd is usually wrong, right? Therefore, most people are expecting the trend to stop or to change or to halt or the market to reverse much, much earlier than the market actually is ready to reverse. You see that in Euro USD, right? There were a lot of people looking at Euro USD and anticipating the sell. Like, no, this market has been selling for too long. It needs to start going up. Only for them to get caught up every single time they try to buy. So, for example, a lot of people have seen this and say, oh, this is a double bottom. Price wants to go up. Price to come down and flush them out. Again, they'll see it. Oh, this area is a key level of support. Price will come down, flush it out. And the market will keep doing that because more people, or the majority of people, are looking to counter trend trade. However, for me, I'm more interested in trading in the direction of the trend. And so I want to focus on knowing what the actual trend in the market is. I hope that makes sense. Okay, so that's my, a little bit of example of, explanation on Dow's theorem of market movement. And this understanding, a proper understanding of this will enable you to at least figure out how to continue to trade in the direction of the trend and not get sidetracked or distracted by those false breaks. You know what we call false break? Oh, it appears the market has broken structure, it's now bearish or it's now bullish, not knowing that the market is still in contention to continue to move in the direction of the overall trend. This is, I think we've explained a lot on Elliott Wave. Remember, I know some of you are very brand new to trading. You'd also be able to, you could also take the beginner trading courses from the ANZO Training Hub as well. That will be made available to you very shortly, not in this class, obviously, from either some of our representatives or myself as well. But that's the much that I'll be taking on this class. I hope you enjoyed the training. Now I'll also be looking to take your questions.